Hi there. In part 2 of our series on international currency markets, I discussed foreign exchange risks and hedging using derivatives. For those of you who may be inclined to delve deeper into the subject, I have posted on my blog the 2022 BIS Triennial Survey of Foreign Exchange and over-the-counter interest rate derivatives market. I have also posted the UK data, which is the single largest center of foreign exchange activity, with a share of 38.1% of global turnover. Both were published on Thursday, 27 October 2022. If you do go through those reports, you will have an appreciation of the sheer volume of trades that take place daily across all derivatives. And now on to today's discussion. If you are a central bank, how do you determine how much money should be in circulation? And more importantly, what is its optimal growth rate? Remember, excess money can be inflationary, and you certainly don't want that. On the other hand, too little can put a constraint on the economy. As you may guess, therefore, it is important to measure the money supply systematically. You can't just supply any haphazard amount based on gut feeling and hope for the best. Ideally, you want to match money supply with the demand. So, how do you determine the demand for money? The answer to this question is the subject of our discussion today. This is part 4 of our series on money. I had planned this as part 3, but when an associate commented on the difficulty of part 2, monetization, I decided to shelve this. I have, however, decided that the discussion on money would be incomplete without this episode. Before I continue, however, do visit our website where I curate news and publications from international financial organizations and world central banks. Topics cover a wide range of financial and economic issues that affect individual countries or the world economy. For instance, COVID-19, inflation, or the war in Ukraine. Please also subscribe to this channel and be informed whenever we publish a new video. The question of the demand for money deals with the variables that determine how much money is needed by the economy and what should be its growth rate. This is important in constructing a model of the monetary economy, which in turn is important for conducting monetary policy by the central bank. There are two main approaches to the demand for money, one being neoclassical and the other being Keynesian. The neoclassical approach stems mainly from the American economist Milton Friedman's restatement of the quantity theory of money. But Gowland and Coughlin argued that Friedman's theory of the demand for money was in many ways a restatement also of Keynes' theory of the demand for money. According to the neoclassical approach, money is considered a normal good. Therefore, the demand for money should behave like that of any other normal good. That is, it should have positive income elasticity and negative price elasticity. The price of money, that is the opportunity cost of holding it, is the rate of return on alternatives to money. Since both financial and real assets are alternatives to money, the demand for money should depend on the rate of return available on these. In addition, of course, it should also depend on the price level and the level of real income. Gowland identified 6 variables on which the demand for money should depend. 1. the general price level with a positive elasticity. 2, the level of real wealth with a positive elasticity. 3, the level of real income or output with a positive elasticity. 4, the rate of return on short-term financial assets with a negative elasticity. 5, the rate of return on other assets, including real assets, with a negative elasticity. And 6, the own rate of return with a positive elasticity. The Keynesian approach, on the other hand, postulated motives for holding money, namely the transactions, precautionary, and speculative motives. The transactions motive for holding money derives from money's function as a medium of exchange or means of payment. Individuals will hold money to carry out current transactions. Although, according to Hicks, this is not a demand but a requirement for money, Coughlin argued that this ignores the temporal aspect of exchange, the lags in the system between receipts and payments. Once these are considered, it is only sensible to consider a demand for transactions balances. This transactions demand is a function of expected income, and it has positive income elasticity. The precautionary demand is also a transactions demand, but it differs from the above insofar as it is forward-looking concept. That is, individuals will hold certain money balances as a precaution against unforeseen future expenditures. It caters for the uncertainty in transactions to be carried out in the future. It also depends on expected income with a positive elasticity. The last motive for holding money is the speculative motive. In the Keynesian view, there are only two kinds of assets, money and bonds. Bonds are government debt, that is, they are claims on the government, and they pay their holder a fixed coupon rate. According to Gowland, because of this, bond prices move inversely with interest rates, and so their attractiveness is affected by the movement of interest rates. This is because individuals have a view about the normal rate of interest, and hence when rates fell below this rate, they were expected to rise. Thus, when bond prices are rising, bondholders would sell with the view of buying them at a lower price when prices have fallen. This then was the speculative demand for money. It was postulated to depend on the rate of interest with an almost infinite interest elasticity. Although the different motives have been attacked on specific issues, a general criticism is also leveled at the motives approach. If money is a normal good, then its demand should be analyzed like that of any other normal good. Using the demand for television sets as an example, Gowland argued that just as we postulate a downward sloping demand curve for television sets, without specifically analyzing the news demand and the opera demand and so on, we should postulate a downward sloping demand for money function without analyzing the motives for holding it. But the monetarist Keynesian debate regarding the demand for money did not end there. There was also disagreement about the nature of assets that could be regarded as substitutes for money. Keynesians regarded only short-term financial assets as substitutes for money. Hence, for them, the opportunity cost of holding money was the rate of interest on these assets. For monetarists, no financial assets were close substitutes for money. If individuals wanted to alter their money balances in response to a change in income, they would just as much sell or purchase financial assets, both short and long term, as sell, purchase real assets including consumer durables. Therefore, the opportunity cost of holding money is the rate of return on all these alternative assets. The nominal rate of return on real assets is proxied by the expected rate of inflation on the grounds that the two should move in line. This controversy about the nature of assets that can be regarded as substitutes for money was also at the core of another disagreement, this time about the transmission mechanism of monetary policy. Because Keynesians believed short-term financial assets were direct alternatives to holding money, their transmission mechanism was an indirect one, acting through the interest rate. Therefore, as a policy prescription, Keynesians advocated the interest rate as an intermediate target. On the other hand, because they viewed financial as well as real assets as alternatives to money, the monetary's transmission mechanism was a more direct one. If in response to a change in their levels of real income and wealth, individuals desired to change their money balances, then they would as much move into or out of financial assets, both short and long term, as they would alter their patterns and levels of expenditures on real assets, including consumer durables. If the economy was at full employment, that is, at its long-run equilibrium, then these changes of expenditures would have repercussions on the price level. Thus, at full employment, an increase in the level of income, all other things being equal, would boost aggregate demand and so lead to inflation. Because monetarists believed that money caused income, therefore at the policy level they advocated the money stock as an intermediate target. A controversy of a different kind was over technical considerations. First, and largely stemming from the disagreement over the composition of substitutes to money, there was disagreement over the arguments to be included in the demand for money function. Second, there was no agreement over the form of lag to be incorporated in the demand function and on the form of expectations. Third, there was no agreement over the appropriate measure of the monetary aggregate to be considered. As Coughlin argued, the matter of the definition was very important as this affects the estimation approach. Also, empirical studies in the United Kingdom had shown that adopting different measures of money, that is M1, M2, etc., produced different regression coefficients, as did short and long-term interest rates. However, according to Coughlin, no study had yet attempted to take explicit account of the problem of definition of money. But in the view of Coates and Cathcart, the issue of the definition of money should be decided on empirical grounds. That is, no a priori decision could be made on which monetary aggregate to use. According to them, empirical validation is necessary for each country. Recent literature has suggested that the demand for money function was stable up to about 1980 and broke down thereafter. The reason given for this is that the banking deregulation post-1980 created a broader set of money substitutes, and therefore the demand for money function should be altered to include these new money substitutes. It is argued that the complexity of a modern financial system requires a further broadening of the definition of money, which is relevant for understanding many monetary and banking issues, including a modern transmission mechanism. For instance, the implementation and efficacy of tools like quantitative easing is directly related to this new thinking on monetary aggregates and the transmission mechanism. A related concept is the velocity of money. I shall not discuss this here as it would require an episode by itself, but suffice to say the velocity of money essentially measures the rate at which money in circulation is being used to purchase goods and services. The Federal Reserve Bank of St. Louis defines it as the frequency at which 1 unit of currency is used to purchase domestically produced goods and services within a given time period. In other words, it is the number of times $1 is spent to buy goods and services per unit of time. If the velocity of money is increasing, then more transactions are occurring between individuals in an economy. The frequency of currency exchange can be used to determine the velocity of a given component of the money supply, providing some insight into whether consumers and businesses are saving or spending their money. There are several components of the money supply: M1, M2, and MZM. These components are arranged on a spectrum of narrowest to broadest. Consider M1, the narrowest component. M1 is the money supply of currency in circulation. That is, notes and coins, travelers' checks by non-bank issuers, demand deposits, and checkable deposits. A decreasing velocity of M1 might indicate fewer short-term consumption transactions are taking place. We can think of shorter-term transactions as consumption we might make on an everyday basis. Beginning May 2020, M2 consists of M1 plus 1 small denomination time deposits. That is, time deposits in amounts of less than $100,000, less IRA and CAF balances at depository institutions, and 2, balances in retail money market funds. That is, money market funds, less IRA and CAF balances and money market funds. MZM, that is money with zero maturity, is the broadest component and consists of the supply of financial assets redeemable at par on demand, notes and coins in circulation, travelers' checks by non-bank issuers, demand deposits, other checkable deposits, savings deposits, and all money market funds. The velocity of MZM helps determine how often financial assets are switching hands within the economy. This definition is courtesy of the Federal Reserve Bank of St. Louis. As a final point, you may have noticed that the definition of money supply aggregates proceeds from real money outwards. This is related to another concept called near money or quasi-money. So first you start with real money, then you proceed to add near money, and continue until you have added all assets that are as close to money or may be regarded as substitutes as possible. Wikipedia describes it thus: near money or quasi-money consists of highly liquid assets which are not cash but can easily be converted into cash. Examples of near money include savings accounts, money market funds, bank time deposits, that is, certificates of deposits, government treasury securities such as T-bills, bonds near their redemption date, foreign currencies, especially widely traded ones, such as the US dollar, euro, or yen. Near money is not included in narrowly defined versions of the money supply, but broader versions include some type of near money.